Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. However, we are filming this one on a Saturday. I apologize, guys. Had a few things to take care of last night, so we're filming this one day late. But still, we are here and we're going to take a look at what happened in Friday's trading and also get ready for the upcoming week. So without further ado, guys, let's get right into today's video. So on the day on Friday, SPY down 0.19%. QQ was actually the only bright spot in the market, as the rest of the markets were really just in a bit of consolidation mode. Very healthy consolidation indeed. No major red flags at a first glance. Your major loss leaders on the Friday were XLF Financials and IWM Russell also pulling down about 1.38%. Most of that, guys, was due to a drop in KRE, your small and regional banks. Keep in mind, guys, KRE, their small and regional banks represent about 17-18% of IWM Russell's entire holdings mix. So that's why a large percentage of your IWM drop can just be attributed to the overall sell-off in financials. But other than that, guys, it was a relatively healthy day. Take a look at the heat map right here. You can see that for the most part, big tech was an outperformer on the day, led by semiconductors. We did have some pullbacks in healthcare and financials getting a much deserved cool off. I know you see multiple digit percentage decreases here, such as Visa down 2.5%, MasterCard 1.5% to the downside as well. But in the grand scheme of things here, guys, financials looking very, very, very healthy. Just a little bit of consolidation after pretty much a week's worth of green. So in today's video, guys, we're going to be taking a look at two company earnings that I have prepared for you. Number one is going to be CHEWY, the pet supply company. And then we're going to be covering MICRON, which had earnings as well on your last Thursday. So those two companies reporting pretty much, Wednesday after the close. We'll be covering them today. MICRON, obviously a semiconductor play. More specifically, they are a RAM producer, which is a major component, whether it's in terms of smartphones, PCs, and other connected devices, right? So we're going to be covering those two company earnings, then following it up with our major technical analysis rundown on indexes, and then our big tech names. And lastly, wrap it up with my portfolio to see how we concluded the week and whether or not I made more trades for the upcoming week. So let's get right into our earnings previews here, guys. And we're going to start it off with CHEWY. So CHEWY not looking too bad, as I do if I do say so myself here. Now, they are completely crushed in relation to their all-time high, but I do believe at these lower valuations, the company was worth a bit of a revisit, which is why I took the time to analyze this to determine whether or not it's at a decent buy level. So after their earnings, guys, what happened on their earnings? Well, they actually had a double beat. The EPS, they were supposed to come in negative. They actually came in with positive EPS, pleasant surprise here. And they did beat ever so slightly on revenue by about 8% to the upside. Now, to give you a little bit of context of what the issues that CHEWY is facing is, let's take a look at some of my key notes that I wrote down here. So for 2024, it'll be a bit of a transition year. Now, the reason that the stock price had such a steep decline is that they were growing revenue aggressively in 2020 and 2021. The pandemic really spawned a lot of pet adoptions, and also obviously with a bunch of shopping online, not being able to go into stores that much. Well, CHEWY's business simply exploded. But after that, they ran into a little bit of cyclicality here, guys. When consumer trends returned back to normal, people started shopping in stores again. Their sales didn't really drop off, but what did drop off is the growth rate of their sales. Their growth rate was extremely, extremely high, and now has been tapered off to a more streamlined growth rate. So take a look at their growth rates here in terms of their EPS and in terms of their revenue. You can see here that pretty much we are finally starting to get back into that ramp up of positive EPS expansion. But you can see 2022, 2023 for the company really flat in terms of EPS. And in terms of revenue here, guys, right, you can see this net growth acceleration curve, 2019 all the way through 2022. And then it started peaking out in 2023. So it was not that great of a year for them, even though they did expand revenue at about 10%. It was not as aggressive as years prior. They should be resuming aggressive growth here pretty much at the end of 2024. Through 2027. So these past 2 years have been a bit of transition years for the company, and you can see this net drop off here in share price. The company, when it was trading back here, was extremely overvalued considering the fact that they weren't bringing in any positive net margins, but that has since changed, which is the reason why I like to revisit this. So 2024 will be a bit of a transition year. The pet adoption has seen declines versus the pandemic boom. Number two, pricing power has peaked. No price increases for 2024. So if you guys may remember when we go over the CPI numbers, pet and pet products were extremely sticky. And this company did have a decent amount of pricing power, being able to increase its prices as a result of increased inflation. But now, as of most recently on this earnings call, they have said that the pricing power has peaked and they don't expect to be able to meaningfully increase prices in 2024. So most of that revenue increase over this course of this year will be organic revenue increases, meaning from more customers coming to the platform as opposed to just increasing prices. So at least that's good. Now, they do have slightly declining / flat active user growth. That is a little bit of a red flag for the company, but can be due to a bit of the cyclicality that I was explaining before. They do have two positive things that they're addressing now in terms of new markets. They've just expanded it into Canada as of last year. That should give them about a $10 billion total addressable market that they can go and try and capture a large percentage of. And then they're also going into services, more specifically veterinary services. And that business could represent a $25 billion of total addressable market expansion for them, most notably in their US market. So that is a very nice thing that they will be doing. Now, before we get into a little bit of metrics for the company, let's just go over some quick notes that were given pretty much during the earnings report. So CHEWY reported better than expected fourth quarter results, as we saw. However, CHEWY stock declined in Wednesday's extended trading session. The drop stems from the company's lower than expected Q1 forecast, which they did give a slight little reduction on guidance here. Additionally, the company expects its 2024 active customer base to stay flat due to inflationary pressures and subdued pet ownership trends, all of which we were recapping in my bullet points right there. Now, the Q4 earnings highlight, they did beat, as we saw here, guys, they had a double beat pretty much. Now, its company reported EPS of 7 cents, exceeding the analyst expectations of a loss. So that was your positive point there. And the revenue here coming in above the consensus as well. During the quarter, net sales per active customer increased by 12% to $555, which is very, very decent here, guys, to have an increase in your per customer metrics. Now, let's take a look at some of their highlights, guys, from their shareholder slides here. And let's go through this relatively quickly here. So let's put on the slideshow because their PDF was not cooperating. So bear with me, guys. We're going to go through a little PowerPoint presentation together. So here is your financial headlines for CHEWY, rather. Excuse me. So our mission. All right, perfect. Let's go through these fiscal year highlights. So you can see here net sales, very, very decent, over 10.2% year-over-year growth. That's very good. They do have gross margin expansion as well. So meaning that their cost of goods sold is just growing less fast than the revenue. So it allows them to have a gross margin expansion. This is exactly what you want to see. Now, in terms of net income, they are up in net income as well. $40 million to the bottom line. That's very good here, guys. If I just go back to CHEWY, sorry about not covering this at first. CHEWY is not that much of a profitable company as of yet, but they have been doing a good job in increasing their profitability. So if you take a look, 2020, 2021, they were operating at a loss here. But 2022 and 2023, the past 2 years, although it's not a lot of net income, they are indeed bringing money to the bottom line. So they are expanding margins, and that margin expansion should continue now as the company is really growing into its economies of scale, right? So they should be able to really start driving some of that margin to the bottom lines. Now, let's take a look at some future details here for the presentation. So in terms of their active customers, you can see here, that is your year-over-year decline in active customers, still sitting about 20.1 million. Not that much decline here, but still a decline nonetheless. Here you see your average ticket amount per customer, which is about $555, up 12% per year. So it's good. The people that are on the platform are staying and are spending more money. Now, here is a big metric that we're going to focus on. 76.2% of all sales are auto ship customer sales. Now, the reason this is important, guys, this is what you call recurring revenue. So what auto ship is basically is the company offers a discount if you order, let's say you have a cat, right? And you want cat food. And you don't want to go and manually click and buy cat food every single month when you need it. Well, the company is going to offer something like Amazon does, right? Where you can subscribe and save. Basically, if you make your order a recurring order on a monthly basis, you get a slight little discount for doing that. So 76% of all of these sales are actually auto ship, meaning recurring sales to customers, which is very, very good. Just goes to show, guys, that the customer, the company is benefiting from very good brand loyalty as their customers have opted for those recurring purchases on a month-over-month basis. Now, in terms of your, excuse me, I keep doing that on the wrong screen. So in terms of our business highlights here, so our auto ship subscription program, as we were just talking about, delivered nearly 8.5 billion of auto ship customer sales in the full year and continues to provide differentiated convenience for pet parents while enhancing customer stickiness for CHEWY. Very good. That's exactly what we were talking about, right? Here is your margin expansion, which is what you want to see, and free cash flow generation. Free cash flow is now positive. Our expanding margins coupled with disciplined capital spending has allowed us to generate meaningful levels of free cash flow. We exceeded our 2023 free cash flow expectations and generated more than $340 million of free cash flow in 2023, nearly 3 times our 2022 free cash flow. We believe we've reached an exciting inflection point in this area and expect to generate substantial free cash flow on a go-forward basis. Now, the reason this is important, guys, is because this is a growth company. They're growing fairly aggressively, and now they're finally profitable and finally able to bring more of that profit to the bottom line in terms of free cash flow. Take a look at their financials down here, and you'll see that this was a record year of free cash flow for the company. Company prior to 2022, not really having any free cash flow, but as we were saying in the recaps here, the past 2 years, the company has had a nice turn to profitability and is bringing more and more of that money to the bottom line, more and more free cash flow. That is very, very good to see. It's exactly the inflection point that you want to see when considering to invest in a growth company, guys, is you want to see them turn that curve to profitability, start generating the free cash flow, which is exactly what CHEWY is doing right now. So very, very decent for them. Now, further on, they go to add, we operate approximately, so here is some of your market expansion here. So they participate in the roughly $10 billion Canadian pet market. That is their most recent growth metric that they're looking for in terms of inter-market expansion. As well, here we have some further comments here in terms of the pet industry as a whole. So these are very, very important metrics to look at. Looking ahead, the pet category is projected to grow at a similar rate over a multi-year forward period. However, in 2024, the transition year, year-over-year growth for the industry is expected to be lower than the historical average. Unit growth is expected to be muted due to pet household formation trends that remain below historical levels. Tons and tons of people got pets in the pandemic, and now not so many people out and getting new pets. That's what that means. As it relates to pricing, while we're not anticipating a deflationary environment, meaning they don't have to decrease prices, we expect no material pricing benefit on industry growth in 2024. These inputs will most likely result in a year of modest growth for the industry, setting up the industry for a return to normality in 2025. So that's exactly what we're saying, guys. No more pricing power for the company. Now all the revenue increases has to come from user growth and not price increases. So additionally, this year we expect our ongoing automation efforts and OPEX discipline to positively offset our investments, delivering SG&A leverage in full year 2024 relative to full year 2023. So this is just them saying here, guys, that they're going to benefit from cost reductions and they don't expect their miscellaneous expenses like marketing, sales, and other expenses to go up that much. So even though the company's revenue is growing, they expect their expenses to remain relatively the same on a percentage basis. All good trends for the company. Now, so here's their expansion in different markets. We're excited about our strategic priorities, such as our recently announced CHEWY Vet Care Clinics, which allows us to expand our TAM by another 25 billion, which is very, very good here. They'll be opening 4 to 8 clinics this year, starting it off in Florida, which is next to their headquarters. So very, very good that they're expanding into the service business here, guys. Now, let's take a look at some of their financial highlights. I'm very sorry, guys, if this is a bit hard to see, but we're going to go through these quickly anyways. So you can see we had a nice 10.2% bump here in net sales for the year. Their adjusted EBITDA margin is very, very good. That's expanding here as well. Just goes to show that the company really is doing a good job at cost control while increasing revenue. So that is very good. Right. See here are some of their highlights as well. So you see net sales, very nice on an uptrend. Their auto ship, so recurring revenue sales, is also on a very, very decent uptrend. Gross margin, also what you want to see on an uptrend. So keeping expenses relatively similar while growing revenue faster. So the company is benefiting from positive operating leverage. Here you can see they've went from a loss on a quarter-over-quarter basis to a positive net income territory, which is exactly what you want to see. And now we do have record amounts of free cash flow. So all of these things, guys, are extremely good. Now, in terms of the balance sheet, the company is also relatively healthy. Cash and cash equivalents and some of their marketable securities, aka investments that they can sell to raise cash, is sitting at a cool $1.1 billion. In terms of their long-term debt, however, long-term debt is only roughly around $600 million. So they really have 2 times the amount of cash as they have debt. So that is a very good metric. Now, the one thing that I did want to show you as well is their share-based compensation. So share-based compensation for the year is only about $239 million, which is not that much in relation to their total revenue, guys, of roughly $11 billion. It's about 2%, so not that much. The company doesn't really have a problem with share dilution, and you can see that right here. Take a look at their shares outstanding. While the company was unprofitable, they didn't really want to raise debt through capital market offerings such as bonds and stuff like that, so they chose to raise money through share offerings. However, in the last 2 years, since they've been profitable, they have not had a need to dilute shareholders any further. So you can see that their share count here, although it is slightly increasing because of that compensation to management, executives, and employees, it's not really exploding. So this is a fairly decent trend. It's really peaked out here, which is why I like this company a lot, guys. You have a few things coming together at the same time. You have a low debt amount. They're now free cash flow positive and growing. They have low share dilution, like we just saw on this chart right here. It's not increasing anymore. But they just need to control their operating expenses a little bit better, and that should be able to bring them even more money to the bottom line. So everything is working in the right direction for this company. They're finally profitable, costs are under control, they don't need to dilute shares anymore, and their share price is at an all-time low. Now let's take a look at some of their metrics here, guys, to determine whether or not this company is a good deal. So revenue growth through 2027, about 11% per year, which is very good. EPS growth through 2027, 70% per year on average. Now that may seem like a large number here, guys, but in all reality, it's not. It's just because they're going from a negative EPS territory to positive relatively quickly. So this, even though it's not a lot of EPS in terms of dollar amounts, it is significant growth, so we can use that. Now, in terms of their forward PE, at their current share price at about 1660, it's sitting at about a 151, but they are growing EPS fairly aggressively here, 70% per year. It gives them a PEG ratio of about 2.15. You know, anything between 1 and 2 is decent. Above 2 starts getting a little bit rich. But since the company is now just turning profitable, earnings metrics are not the best thing to evaluate a company like this on, not just yet. They haven't been able to have consistent positive EPS for us to be able to use these evaluation metrics. I ran them nonetheless. A better metric is actually price to sales. So whenever you have a company that's barely profitable, or not profitable at all, usually you use price to sales as a much better metric. If you take a look at their price to sales, all it is, guys, is what is the price of the stock currently in relation to how many sales it generates per year. And you can see here the price of the company right now in terms of market cap is about $7.18 billion. In terms of the sales they generate per year, though, that's about $11.15 billion. So if you divide the amount of sales by their market cap price, you can see here that we get a price to sales of only about 1.55, which is very, very, very good here, guys. That's extremely good. Compare that with the most recent Reddit IPO that we saw, right? Unprofitable company. They were trading about 11 times price to sales. And I'll remind you why price to sales is important, guys. It's just really, really logical, right? If I have a business that's making $1 million a year in revenue, but generating no profit whatsoever, right? If I have a 10 price to sales, it means if my business is making a $1 million per year in revenue, would you want to buy my business for $10 million if I'm not making any profit? Well, you know, that usually doesn't sound like a very good deal, right? You're buying my business for 10 times price to sales at that point. It's not that good of a deal. But if I tell you guys that I'm making $1 million a year in revenue and I'm making a little bit amount of profits, but not so much, and I want to sell you that business for 1.5 million, it sounds like a lot better of a deal, doesn't it? So that's why I really like this metric in terms of the company. Now, overall, guys, in terms of the technicals obviously are crushed. The company's trading relatively at their all-time lows. In terms of analyst expectations with the growth and with the fact they're becoming profitable are between $23 and $32. And I would tend to agree here, guys. Just based on this price to sales metric alone, I can see this company at least get about $25-$30 per share before they become slightly overvalued in the only metric that really matters to them. That also coincides with a big previous level of support right here, which should be resistance. And now, the company, in my opinion here, guys, is representing a decent little trade opportunity, and I will probably continue to play some short puts, guys, down here in the roughly $15 range. Seems to be a very attractive level for a company that is really crushed here, and it is turning around the corner to the better. So I will continue to play these. Not going to be a very large allocation in my portfolio, but I do want to give this company a chance because it's been a long time since I've seen this one, and I was waiting for this transition period that they're currently going in, right? The inflection point from negative to positive. That's exactly what I want to see. So if there's any time to be picking up CHEWY, in my opinion, I will be doing it most likely very soon and looking to play short puts around here. Could be a very decent trade opportunity for a potentially, 1.52x. And even if you get 1.52x, guys, their price to sales only really becomes a 2.5 to 3, which is very, very, very reasonable if you ask me as a whole. So that's pretty much everything we had for CHEWY. Hope you guys enjoyed that. Now, the next one we're going to be looking at is MICRON stock. So MICRON, one of your plays that gets grouped up with semiconductors, even though they don't manufacture the true semiconductor chips, all they manufacture is RAM components. And they really have two different components to their RAM offerings. Number one is their DRAM offering. That's basically the RAM. Whenever you buy any iPhone or any computer, right, when it says 8 gigabytes of RAM, 16 gigabytes of RAM. So they manufacture that type of RAM. Right? Then the other type of RAM that they manufacture, or the other type of memory rather that they manufacture, is for, let's say, hard drives or SSDs, solid state drives and whatnot. That's not an actively managed RAM by your computer. Like when the actively managed RAM is the DRAM. So when your computer is on and running things, that's the RAM it'll be using. But when you turn off your computer, right? Well, the RAM that's not in use currently, such as the one in your hard drive or SSD, that represents the other version of their RAM. So they really sell two different products there. It's really, the two only components of their business. And let's go over a few of the fun facts for MICRON here. So they were heavily affected in 2023. This company actually got absolutely crushed. I don't know why Wall Street didn't make them sell off a bit more, because they went through a bad time last year here, guys. It was not good. Take a look at this EPS drop, 2022 to 2023, going way, way negative. As you can see, we won't get back to 21 and 22 until 2025 in terms of EPS comparables, right? And in terms of revenue as well, look at this revenue crush from 2022 down to 2023. Won't even get back to 2022 revenue levels all the way through 2025. Now, why was that? Well, number one, you had a big smartphone and PC slowdown. So as I explained, guys, the company manufactures memory, right? So obviously, when PCs and smartphones are in less of a demand, as we know they were, well, this company's demand gets severely crushed. Now, number two, China firms were banned from buying their chips. This was done pretty much at the beginning of last year, and Micron has had to kind of navigate the market as best as they can and try to reallocate their supply to other people who can buy, since China was banned. And China at that point, guys, represented like 25% of their business. So it was a big thing for them. And number three, huge capex for new factories. So obviously, when your demand is being crushed, number one, by a cyclical nature, smartphone and PC slowdown. Number two, from an external factor such as a government ban, your demand gets crushed. But not only that, guys, you've already outlaid heavy capex, meaning billions of dollars to build new factories. Well, obviously, when you have less revenue coming in and you have the same expenses, if not more, your profits just get absolutely destroyed. And this is exactly what happened with this company. Take a look at their net profit margins last year, minus 37%. This is a company that was usually averaging 20 to about 28% in net profit margin. So you can see, obviously, that negative year of profitability really hurt them. But Wall Street apparently didn't really care. You can see in 2023, the share price didn't significantly decline and really had a nice rebound into the end of 2023 as it got through a lot of these problems. Now, this is some of the highlights as well before we get into it. Just to give you guys a quick summary. They are regaining positive EPS now and are regaining positive net margins now. This most recent quarter, you can see right here, they're back to profitability after spending a year in the negatives. They don't have any more free cash flow though. It's all going to their capital expenditures. So as a result, guys, they've even paused some buybacks. So no more free cash flow for the company. Unfortunately, this was a company that was able to generate some very decent free cash flow in the past. Take a look. I'll bring up the financial tabs once again. And we can see down here, the company didn't have any problems of generating free cash flow from 2019 through 2022. They would roughly generate, anywhere between $2 to $3 billion in free cash flow. Last year got absolutely destroyed because of those heavy CapEx, bills that they had to pay for building their new factories right there. So no more free cash flow. Their debt level is okay, sitting on about $14 billion of debt, $9 billion in cash. A lot of that debt was taken on to build those factories as a whole. And they have decent shareholder or stock-based compensation here in terms of towards employees, management, and executives. It's not anything egregious. It's sitting around 7-8% of total revenue. So that is fine, even though they have paused buybacks. It's not a big red flag in my opinion. So let's take a look at some of the MICRON highlights here from their direct earnings report. So we can see here, one of their headlines, AI demand and tight supply accelerate return to profitability. So a lot of the issues that they were facing in 2023, the cyclical nature of their business slowing down, PC and smartphone demand slowing down, they are happily getting a little rebound here, mostly due to AI. So their demand curve is now finally starting to recover. So let's take a look at exactly what they had to say about that in terms of their PowerPoint presentation, here. So let's go over a few of the highlights from MICRON, their most recent quarter. So overview. Fiscal Q2, MICRON delivered revenue, gross margin, and EPS well above the high end of guidance. MICRON has returned to profitability and delivered a positive operating margin a quarter ahead of expectation. MICRON drove robust price increases as the supply-demand balance tightened. This improvement in market conditions was due to a confluence of factors, including strong AI server demand, a healthier demand environment in most end markets, and supply reductions across the industry. So you can see their markets are recovering. We expect DRAM and NAND, which is, so DRAM is your actively managed RAM, and NAND is, as I said, what you usually find in hard drives or SSD drives. Their pricing levels to increase further throughout calendar year 2024 and expect record revenue and much improved profitability now in fiscal year 2025. So they're turning the corner back around here, guys. End markets overview. Inventories for memory and storage have improved significantly in the data center, and we continue to expect normalization in the first half of 2024. In PC and smartphone, there was some strategic purchases in Q4 in anticipation of a return to unit growth. Inventories remain near normal levels for auto, industrial, and other markets. We are in the very early innings of a multi-year growth phase driven by AI, as this disruptive technology will transform every aspect of business and society. So AI, the upcomings of AI, largely making up for the downturn in their PC and smartphone demand. Now, let's move into some of those end market highlights. Let's take a check on their PC and mobile division. So PC, unit volumes are expected to grow modestly in the low single-digit range for 2024. We expect next-gen AI PC units to grow and become a meaningful portion of total PC units in 2025. So AI helping out their PC division. Now, smartphones. Smartphone unit volumes in calendar 2024 remain on track to grow low to mid single digits. So you can see PC and smartphones not back yet, are they? Only mid single digit growth. Now, smartphone unit volumes, right? Mid-single digits. We expect AI phones to carry 50 to 100% greater DRAM content compared to non-AI flagship phones today. So AI helping both of these requirements, right? Microsoft, Apple coming out with AI PCs. Now you'll have AI smartphones, and apparently that's doing very well for Micron's overall business, as they will require heavier RAM requirements, which leads to an increase in demand for your business. So that's very good. Now here's our outlook and CapEx plan, guys. So in terms of supply, we already know the demand is coming back. We've read that. Now, in terms of supply, how much can they output? Can they match the demand? We expect calendar 2024 industry supply to be below demand for both DRAM and NAND. Micron's bit supply growth in 2024 remains below our demand growth for both DRAM and NAND. And we expect to decrease our days of inventory in 2024. This is good. They're telling you now, finally, as opposed to 2023 when it was the opposite. 2023, supply far exceeding demand because the business was in a little bit of a cyclical downturn. Now, for this year, they project the opposite. So now the demand is far outpacing the amount of supply that they have in the pipeline, which is good. That is a good trend for the company. Now take a look at their CapEx. I was talking to you guys about them building the factories, right? So 2024 CapEx plan remains unchanged. They're going to spend between $7.5 and $8 billion this year on capital expenditures. Announced projects in China, India, and Japan. And also they have US expansion plans too in Idaho and New York. And I pulled them up a few for you guys, just so you guys see how many factories this company is building. India, $2.75 billion that they've started most recently in the past year for their factory in India. Now, they'll have a one in Beijing as well. Keep in mind, this was a beautiful headline, right? MICRON, blacklisted by Beijing because China can't buy their products, is still building a factory in China for the rest of its worldwide requirements. $600 million there, right? Now, in Japan, $7 billion plant underway. They've been building that now for the past year and a half. That's in Japan. And here's the two ones that come in terms of the US here, guys. So they have one in Idaho. The one in Idaho is going to be costing about $15 billion that they're going to be building. They broke ground on that just most recently this past year. And then they have their huge factory. This was announced about 2 years ago. They are about to spend $100 billion over the next 20 years. They're going to be building 6 of these massive factories over the next 20 years. $100 billion, going to create 50,000 jobs in New York as a whole. They have not yet broken ground on this one yet, but just to show you guys, they're still waiting on a few grants and incentives by the government to do this. But just to show you here, guys, so many different projects underway, which is why their profitability really got destroyed last year. A lack of demand and continued capital expenditures on those factories really crushed their profitability. But now everything's good now that the demand has recovered for the company. So that is very good, obviously. Now, let's take a look at some of the further highlights here. So DRAM, right, $4.2 billion on the quarter, representing 71% of total revenue. That was good, increased 21% quarter over quarter. And in terms of their NAND, a little bit of a smaller business, so 27% of total revenue, even that increased by 27%. So both of their major lines of businesses increasing in the right direction. That's what you want to see. Now, cash flow from operations over the quarter, decent, $1.2 billion, but they spent all of that on their factories. That's why I highlighted it, right? $1.2 billion cash flow from operations. We'll just spend it in our factories. CapEx, $1.2 billion for the quarter. Adjusted free cash flow, negative $29 million. That's just because they spend all of their money on capital expenditures. So nothing really much to bring in terms of free cash flow here. And buybacks, well, because of all that free cash flow expenditure to the factories, they have suspended the buybacks, unfortunately. So that is something, over the past 3 years, they had been doing buybacks, but now they have paused. So really their share count is kind of stuck here in limbo. They were starting buybacks in 2018, but you can see their amount of shares outstanding really hasn't decreased notably here, guys, over the past 3-4 years at that point. So we'll really have to wait until they get through most of that factory spending to get any lift from some further buybacks. And that's pretty much everything we had on their presentation. Now, I'm not going to go through too many of their financial highlights, guys. We'll just cover those when we go through my valuations here, right? But in terms of their highlights, I mean, you can see a net increase here in revenue versus cost of goods sold. So here's where they're recapturing their profit, guys. Revenue is increasing. Their cost of goods sold is remaining roughly flat versus last quarter. So you can see company does have positive operating leverage, able to grow revenue more than cost of goods sold. That's very good. And I just wanted to show you that their operational expenses, research and development, and their SG&A really isn't that high here, guys, only representing about 15-16% of total revenue. So that's a very good metric as a whole. Unfortunately, they don't provide year-over-year numbers here in these tables, so we'll have to go with that. Cash and cash equivalents and short-term investments, you can see here, guys, they're sitting on about, these two numbers, about $9 billion, let's call it, right? And in terms of their long-term debt, you can see long-term debt plus their long-term lease liability is about $14 billion. So as I say, they have a bit more debt than they do have cash on hand, but still it is fairly decent. And here's your stock-based compensation, only $400 million. $400 million in the grand scheme of things here, guys, when you're making $5.8 billion is not that much at all, right? So if you just take 400 divided by your 58.24, it's about 7% of, stock-based compensation, which is not that terrible. So it will be diluting the shares ever so slightly since they're not doing buybacks, but still really not that bad in my opinion. So where does the company stand in terms of valuation here, guys? Well, let's take a look, okay? So revenue growth through 2026, they'll be growing at about 25% per year, which is very, very good. But keep in mind, it's because of the comparables, right? We're growing from negative pretty much in revenue and EPS. So revenue is growing from a super low point. That's why it's so aggressive. And EPS is growing also from negative back to positive. So that's why these numbers are a little bit misleading here. So you just got to keep that in mind. In terms of their forward PE for 2024 at $110, which is their current share price, 167. But when we take that as an expression of their growth rate here, you can see their PEG ratio, 1.96. It's not the best. It's between 1 and 2, but still a little bit on the high end for me. This company personally would just be a technical trade. The valuation is not the best. The company is still in a little bit of a transition period here. Right? So what we could be potentially expecting is we have this beautiful previous area of their all-time high back around $97, $98, right? Now that we're breaking above it, we could be looking for a little bit of a breakout retest trade. This is the only time that I would most likely wanting to be play this company is on a retest of their previous all-time high. That would represent a little bit, cup and handle trade, breakout retest, and potentially run as your AI boom, and semiconductor boom simply just continues. Micron will be lifted up with the rest of the industry. I do assume so as well. So if we do come back here in 97, maybe a little bit of an opportunity for a swing trade, but I'm not really, biting my fingernails, nervous that I'm missing out on this company at all, guys. If you want to know my favorite, manufacturing play for semiconductors as a whole, it really has to be Taiwan Semiconductors here. Their PEG ratio is really fantastic. Taiwan Semiconductors represents the best risk to reward of any of the, semiconductor manufacturing plays. Them really, and ASML. ASML also is pretty good, even though their valuation is slightly elevated. I really like this company better. I do think that they're set up better as a whole in terms of the product that they offer. They make the machines that make the semiconductors, and they have a straight monopoly on that across the world pretty much here. So, maybe the share price is a little bit rich to be writing short puts, but for a little bit of a swing trade back to the all-time highs, right? All of these plays are the same thing, right? ASML, what are we looking for here? Retest of your all-time highs back around here, 833 for a potential run. TSM, what are we looking for here? Retest of your previous all-time high range, which is currently doing right now back in that range for a potential run. And Micron is just the same in terms of technical setup, right? We're looking for maybe a pullback to the all-time highs and run. My two favorite plays, guys, for the people that build the semiconductors has to be TSM and ASML as a whole. But Micron, happy to see that they are on a healthy recovery story. So hopefully that was educational and helpful to any of you that are looking into investing in Micron in order to help you guys make your own decisions. So with all that out of the way, guys, let's get right into our technical analysis. And not much has changed, so we'll go over these relatively quickly here, guys. So SPY still in full control after that big engulfing move after Powell spoke. We are now back in a daily uptrend right here. Just going to be looking for a daily higher low, anything above 507, daily higher low for further trend continuation. Keep an eye, guys, two little lines coming up here. One is going to be your previous resistance point right here at 517. Should offer a decent little pullback area. And you do have your 12 EMA, this yellow moving average right there, which will also be coinciding roughly the 517 to 516 area. That should be your first line, expecting a little bit of a touch and maybe go back up to the trend line right here. Trend line expectation about 531. We don't have that much economic data coming out on the first half of this week, but the last half of the week, Thursday and Friday, we do have some important reads here. So GDP is going to be coming in on Thursday. That should be a positive event for the markets. And then on Friday, we have an inflation report coming in, the Fed's preferred inflation gauge, the PCE report. So we will see whether or not that one too comes in hotter than expected, as is measuring February data. CPI, PPI came in hotter than expected. Now let's check on PCE to see what happens with that one. So those are going to be some likely news events that could move the markets later on into the week. But as of now, bulls, guys, absolute full control, weekly full control, monthly full control as well, right? So we're just gonna be keeping a close eye on the daily, day to day, to see if ever this control shifts into a daily downtrend. That's when we have to take notice. But as of now, everything looking quite decent. Moving on to QQQ, sluggish a little bit on the day, 0.11% to the upside, but still green. So QQQ doing a great job here of putting in an engulfing move. We were in a daily downtrend, looking for the break of the trend line. Didn't happen. Powell really saved us on that one. So at this point, guys, we're going to be looking for the engulfing move, looking to set the higher low for a potential daily uptrend recapture by the bulls. They have not recaptured it yet, but they have a decent opportunity to do so. 12 EMA is right down here, 441. And then you have a few major confluence areas. So keep an eye, guys, on this level right here, 435 is going to be horizontal support, and you also have the bottom end of the trend line too, right down here at about 438. So this whole 438 to 436, very solid support area in my opinion. Going to be tough for the bears to get through that one without any negative macro news. So we'll see how those news events on Thursday and Friday impact the markets. But if they're relatively tame, if GDP is decent and inflation isn't too hot, then I do expect QQQ, even if we do come down to this area, to get a little bit of a bounce and just reset the daily uptrend to the upside. No red flags as of yet. Now moving on to financials. Financials also looking good. So we are pulling back at this point here, guys, but the pullback is extremely healthy. Keep an eye on this beautiful daily uptrend that we're still in. Any pullback just looking for a daily higher low, anything above 40.5. Daily higher low for further trend continuation. Now, we get a little bit nervous here if the bears engulf too much of the move, crush the 12 EMA as well to the downside, set up the lower high and lower low. As of now, there's no immediate signs of that forming. Keep an eye on your 12 EMA. You can see how well the bulls have defended your 12 EMA over the past 4-month rally. We are dealing as well with a bit of a resistance area, right? Your previous all-time highs acting currently as resistance as well. So we'll keep a close eye, guys, on this level right here. 40.5, going to be in a crucial area. If the bears take back too much of the move, they open the door, lower high, lower low, and at that point, we'll just be in for healthy weekly consolidation on financials. Financials, anything on the weekly, anything above 37, just for a weekly higher low for further trend continuation. But as of now, that is not in the cards just yet. Need to see the daily pattern roll over first before we go into weekly consolidation. So as of now, Friday, a little bit of healthy pullback. Now moving on to healthcare. Healthcare not looking too bad either. We're still keeping a close eye on our lows right here, 144.7, because if we lose those lows, it'll be daily downtrend and will just be continuation of your weekly consolidation as well. As a whole, the bulls are playing pretty good defense. We're trying to defend these moving averages as good as we can. But this week is going to be crucial to maintain these lower lows. If we break them, as I said, just in for further weekly consolidation. And on the weekly, guys, anything above 137.40, just still looking for that weekly higher low for future trend increase. How will you know the weekly chart has bottomed out? Well, we need to see the bulls recapture a daily uptrend right here. So that would be a break in this case right here. We would need set the daily higher low as of Friday's close of trading, and then we need to crack 146.23, right? So keep an eye on the break of 146.23. If we get that daily uptrend back, it'll mean that your weekly chart has likely bottomed out. You can see here, past 4 weeks has been unable to come below there, and then we're just looking for furtherance of the trend expansion over 2024. All in all, guys, looking very good, and even if we break this to the downside, it's still looking good. Anything pretty much above 137.26, still looking for the weekly higher low for further trend continuation. If we break this line, probably heading down to the 12 EMA, even your previous all-time highs, 143, 142, such a great spot here, guys. Previous all-time highs, that could be the likely area where we do bottom out on this downswing here for the future uptrend. Now moving on to IWM Russell. So as we were saying, guys, IWM really being brought down by financials over the course of the week, but still looking somewhat decent if I do say so myself. Daily downtrend into engulfing move, engulfing all of this second leg. Now we have the enough space to create a daily higher low, looking for them to set a daily higher low, anything above 199.65, higher low into potential daily uptrend swing. Looking good. We're still above our previous area of resistance, this red box right here, right? So we're just looking for the stocks for IWM to really bottom out, use this whole previous resistance zone as a juicy area of support before putting in a nice weekly leg higher. The bulls are looking really good here, guys. We have monthly trend control right now. We have weekly trend control as well. Gorgeous weekly uptrend. And on the daily bulls are really looking to really consolidate this and put in a new daily uptrend. If they do that, then all of your major timeframes here are to the bulls, monthly, weekly, and daily. And when we get all those three in the right direction here, guys, that's when we really get the trend expansion to the next level. And in my opinion, that next level is going to be right here, 211 on the dot. Very big area of resistance right here, right? So 211, let me just extend it all the way up here. 211, you can see huge previous support, big resistance, couldn't get above it. That's going to be the next area. And then we come into this massive chop zone all the way up here, which pretty much peaks around 232. So that's going to be a very, very, hard level for IWM to break out. Once we break into this level, guys, it'll probably be very, very choppy when we get there. So those are just a few overhead targets, but I do believe IWM should have a fairly decent year. It's just probably going to run a bit harder when rates are, focused to come down here in June and July. IWM will probably rally a bit harder around those times just because so many of these stocks are exposed to interest rates. And with the Fed's meeting last Wednesday saying pretty much higher for longer, well, you know, these stocks really have no need to run right away, but it's coming soon, guys. In my opinion, the best time to be investing in the IWM will be pretty much closer to your rate decline expectations. So most likely closer to June and July. May would be a pretty good time for me. Now moving on to Dow Jones. Dow Jones looking very healthy despite its Friday pullback, right? Beautiful daily uptrend. Little bit of a pullback here, looking for a daily higher low, anything above 36,700 roughly. Daily higher low for further trend continuation. We have a beautiful area. Your previous all-time high should be acting as newfound support. Your moving averages are going to be right there as well. So that's where I expect the bulls to put up some very good defense, potentially just move this trend on higher on the daily. So no red flags on the daily whatsoever on the Dow Jones, looking very good. On the weekly as well, we have a new weekly leg up on the Dow Jones. So at this point, guys, this will be leg number 3 that we've started pretty much since the month of November. 1, 2, 3, very healthy weekly legs up. And we may just be due for a little bit more. No red flags. Monthly bulls, full control. Weekly bulls, full control. Daily bulls, full control as well. Where we get worried is if we end up in a little bit of a daily downtrend like this and lose your 12 EMA consistently, right? As you saw, we didn't do that in the month of March, pretty much, even in the month of late February. Couldn't lose both moving averages and really consolidate below. So your bulls remained in full control. The key points for this chart, guys, are going to be the moving averages. We have not lost them in the past 4 months. So look at your daily control, right? Higher highs, higher lows, and look for your moving averages. If we lose the daily uptrend while losing your moving average to the downside, that's when you're going to get the bigger weekly moves. So far, no indication of that just yet. Now, let's move on to a little bit of crypto. I didn't cover it on Thursday, but crypto relatively muted as well, right? Bitcoin still in a bit of a daily downtrend, looking to protect this double bottom area right here, 60,600 roughly. But if ever we lose this, your daily downtrend continues and the weekly bulls have tons and tons of space. Anything above 39,000 pretty much, guys. Just going to be looking for a weekly higher low for further trend continuation. Now, we could come down all the way as low as our previous areas of all-time highs, this lower range right here, which would be about 57, 58,000. And your moving average is curling up fairly aggressively right now. So that could be a decent little average in territory. That's where I'm personally looking out for some next buys on Bitcoin. The lower 57, 58,000 seems to be a good place for me. But your long-term bulls are in absolute full control. Monthly full control, weekly full control as well, and the daily just really consolidating now still. So still just hunting for those weekly higher lows on cryptos. As a whole, no real long-term red flags, but we'll just see, guys, if we continue to get some pullback, in my opinion, represents a decent buying opportunity. The halving event is obviously in April, and after that, historically, you do usually have some very nice price increases after the next 6 months after the halving event. Moving on to Ethereum. Ethereum largely displaying the same structure as Bitcoin, right? So we are still in a daily downtrend on Ethereum. We'll be looking to protect these lows, trying to set up the new daily uptrend. That would be a break of 35.72, right? That's when you regain your daily uptrend. That's when you know your weekly downtrend has, or your weekly consolidation has likely bottomed rather. In terms of the weekly's looking gorgeous, right? Still a beautiful weekly uptrend. Just looking for that weekly higher low, coming really close to our weekly moving average, right? That's sitting roughly around $3,000. So I still maintain, guys, 3,000 is still a decent buying opportunity, right? Anything 2,500, all the way at about $3,000 is going to be a very juicy buying zone for me personally. So if we do dip into this area, sub 3,000 down to 25, I will be averaging in a little bit harder on Ethereum myself. All in all, though, looking good. Just some very healthy consolidation. So look for 2 things, guys. The break of the lower bound, that would just mean weekly consolidation continues. At that point, target your 3,000 area, as I was saying. And if for whatever which reason we break it to the upside here, talking about 35.81, daily uptrend resumes, and then we'll be looking, guys, to potentially put another weekly move higher. So keeping a close eye on crypto. Crypto looking good, not gonna lie. Now moving on to our big tech names. So big tech, Apple, let's start it off here. Give me a quick second. All right, let's get started on Apple. So Apple, obviously after the huge negative day on Thursday, was tough for them to recover on the Friday session, but still on the Friday session, off roughly about 0.5%. So that's pretty decent. Still looking out for Apple to protect these lows. You can see we barely cut our previous lows. The daily uptrend, guys, is struggling. I'm calling this pretty much a double bottom currently. Didn't have a close below, trying to protect the daily uptrend with all they can here, guys. Shorter term time frames, the bulls are really trying their best to recapture the hourly uptrend. We'll see if they can do that into the Monday session. Thursday session, if you didn't see my video, guys, in my opinion, very overblown for Apple. Short-term problems, not going to ruin the long-term prospects of the company, to say the least. That being said, keeping a close eye on our downside levels here. Very, very juicy levels down here for a buying opportunity, in my opinion. That's why I've been playing it so aggressively. 168. Need to keep a close eye on this level. It represents the lower bound of your past support level. That's been in act since pretty much last fall of 2023 and is your previous all-time high resistance. So this level, this green box that we've been stuck in right now, good support area for the bulls. So far, we have not lost it. So we will be looking for the bulls to protect these lower levels here. If for whatever reason during this course of the week, we lose the 170.75, well, it opens up the door for lower high into lower low. And at that point, guys, we will be looking out to the lower bound of this whole range, which is sitting roughly 165 to the low end. But all in all, Apple trying to make that recovery. So let's just be a little bit patient with it. All of that in the context, guys, of a severe weekly downtrend, right? So we really need the bulls to put in a stop around these lower levels and get this daily uptrend back in motion so we can really start reversing more and more of this weekly downtrend, create some space, and set a weekly uptrend later on in the year. So far, though, short-term catalyst weighing negatively on Apple, in my opinion, does represent some juicy value down here. That is why I've been playing it once again so aggressively. Now moving on to AMD. AMD not looking too bad at all, down to about 179.65, under 180, but 0.5% up on the day. So AMD is still stuck in this little bit of a downtrend right now, right? So really what we need to see from the company at this point is if the bulls want to regain short-term structure, need to see a break of 193.34. That would engulf the most recent move, set themselves up nicely to create the higher low using this previous higher end of this range as support, right? And potentially go for the breakout, retest, and run at that point. So on the weekly, not looking too bad either. This has just been very healthy weekly consolidation for the stock. Gorgeous weekly uptrend. Coming into this area, as I've said, guys, this big range right here, going to be very tough for the bears to get through that, in my opinion. You can see here, they struggled with it for 5 weeks back in January and mid-February here. Going to be tough for the bears to come down here. So if AMD, for some which reason, continues selling off in this area or maintains in the mid 170 range, I will be targeting some swing trades, guys, in the mid to low 160s. That is the bottom end of your previous weekly higher lows, and it's also the previous all-time high. So this is a very heavy area of support. You can see it best on the monthly as well. If for ever which reason over the next couple of weeks, we continue just downtrending right here on the daily, further weekly consolidation, well, look, guys, that's just going to be looking out for a monthly higher low, and the best place that I can find for it is your previous all-time high, aka the low 160s, higher low for further trend continuation as the AI and semiconductor boom just continues over 2024 and 2025. So AMD looking good, finally getting back to my swing trade area. Looking forward to playing more of it as I did first finally start playing it last week again. Moving on to Amazon. Amazon trying for the breakout here, guys, right? Coiling up so tight in the 178 area. 178 was huge resistance for the company 2020 and 2021. And now we're looking to break that to the top again. So you can see we're getting the breakout. This could be a little bit like exactly what Microsoft did in the past, right? They were kind of struggling to break out of this range right here. Once we started getting those breaks, we got the follow through. I will be looking for Amazon to mostly complete the same pattern. Daily uptrend leading into a big resistance area. Company, in my opinion, if the rest of the market holds green over the course of this week, I do believe that this is going to be Amazon's hour of breakout. That being said, if we consolidate a little bit, anything above 173.80, still just a daily higher low for further trend continuation. Need to get over this area, guys. This has been the area that's been rejecting us for the past 3 weeks at this point, but we're getting closer and closer, right? Tightening up. This is a very beautiful bull flag, in my opinion. You see it best on the weekly. Take a look, gorgeous weekly trend right now. And now we have a weekly bull flag. Bulls maintaining the same levels here, top end of the range, bull flag, potentially for explosion into the 180s. At that point, guys, we're pretty much going up to 188, and the next stop will be your psychological 200. So I am looking for the breakout of Amazon over the course of this week. This tightening bull flag, guys, at the top end right here is just so gorgeous right now. It's really a perfect flag opportunity, in my opinion here. Looking very good for the breakout. So I'll be playing it this week on the breakout. And I actually did take a little bit of a juicy play on Amazon, which we'll take a look at the end of the video. Now, moving on to Google. Google looking absolutely fantastic again, 2% to the upside here, guys. Google's rally simply continues at this point. Daily higher low is set 147.18. So if this move tops out, going to be looking for the bulls to protect for 147.18. Right? Daily higher low for further trend continuation. We're coming closely up on our all-time highs, guys. Previous all-time highs, roughly the 155, 156 level. You can see here that we're still not clearly above it, however, though, right? So still dealing with that whole region, 154, 155, still a little bit of resistance for the stock currently, but Google is looking fantastic. Now, if for ever which reason, guys, we pull back a little bit more than expected and crack these lows and potentially go into a daily downtrend to fill this gap area, after the Apple AI news and Google partnership AI news, right? Well, just going to be looking for a weekly higher low here, guys. The bulls look at this recapture, right? Weekly downtrend, and now we have an engulfing move. So now at this point, we're going to be looking for the weekly higher low when it comes for further trend continuation, guys. I really think that Google now has gotten through a lot of the short-term negative catalysts that has been plaguing it over the past 2 months roughly, which has led to it really trailing the indexes as a whole. Take a look at the year-to-date performance. Google is only up about 7.69%, trailing behind its peers, right? It's trailing behind twice of what Microsoft has performed, which is the lowest of your big tech performers. And, you know, Apple obviously being the worst, but Google still not having that much upside on a year-to-date basis. I love the valuation around here. That being said, if we dip below 150, I will be continuously looking to play this, guys, in the 147 all the way down to about 145 range. Your moving averages are down there as well. So looking forward to playing Google aggressively in these ranges as we continue to build, you know, upon this previous support zone. The better one is obviously down here, 141 to 138, but I really think that is now behind us, guys. We're probably going to have to move this zone up to the next available zone, which at this point is 147 all the way up to about 144. So these are going to be the new lines that I don't believe Google is really going to be able to smash through now that it's gone through most of its negative headlines. So looking forward for the company to be able to protect these two levels. This is my new area that I'm targeting swing trades, 148 down to about 144. Moving on to Meta now. Meta with some very nice performance on the day, 0.36% to the upside, and in the context of an overall daily new uptrend right here. So looking good. Meta is currently trying to attack its previous all-time highs, 523. If it can manage to successfully crack that, we're heading all the way up to 550 psychological here, guys. Really no red flags on this stock whatsoever. Beautiful defense of this 12 EMA. New daily uptrend currently. Any pullback, just looking for a higher low, anything above 482, higher low, probably using the 12 EMA once again as defense and move higher for the stock. Weekly is looking gorgeous as well, has been in a weekly uptrend now pretty much forever at this point, right? Ever since we started rallying off the lows about, you know, a year and a half ago at this point, never losing the weekly uptrend at all. And this time is no different, right? Weekly uptrend, weekly higher low is set here at 475 and just looking to maintain those levels. We'll take this one day at a time, but so far Meta bulls are in control of everything. Moving on to Microsoft. Microsoft also looking very poised to continue its breakout further than the all-time highs here. Next area of resistance currently about 450 psychological. Gorgeous daily uptrend, guys, coming out of this range. This literally looks exactly like it did back here. The breakout is not similar. You can see here we never retested the range. Here we retested the range and ran, but it's mostly the same if you look on the weekly, guys, right? Beautiful move up, sideways consolidation at the top end of the move, right? Not giving back too much. Explosion. Here we go again. Move up, consolidation relatively in the top third of this entire move. Consolidation sideways, weekly move higher. So Microsoft is looking gorgeous. Monthly, full bull control. Weekly, full bull control as well. New weekly uptrend started and daily full control as well. If we do pull back here again, guys, take a look, 12 EMA and the top end of your resistance line as well, which is now support 415. So 420 down to 415. Huge area of support for Microsoft if ever we need to pull back before mounting another rally all the way to 450. no red flags. Moving on to Netflix right now. So Netflix trading about 628, up 0.85%. Netflix has really just been a grinder of a stock, right? Really grinding higher off the back of this 12 EMA. Looking good though, right? In the context of this daily uptrend. Any move lower, just looking for a higher low, anything above 603, just looking for that higher low and further trend continuation right now. No red flags at all. We're now clearly above our previous supply area, roughly about the 620 range. We're now above that. Our next area we're targeting is about 700 all-time high resistance. The weekly is also looking very fantastic for this stock, right? Continued weekly move higher at this point. So looking very good. No red flags. Anything above 550, guys. Even if we lose this daily uptrend right here and we get hit with some negative company specific news or something like that, which I would highly, I would be very, very surprised from that because the company's been performing beautifully recently. But let's say we get a negative headline, like Apple and Google have been having, right? Your next area of support down here is the big one, 575. We'll just be looking for a healthy weekly higher low for further trend continuation. So no red flags on Netflix whatsoever. Personally, I am looking for a little bit of a pullback to be interested in buying this stock, and that's the level that I'll be going for here, guys, 575. Moving on to NVIDIA now. NVIDIA, what an absolute monster, right? 3.12%, but we kind of saw it coming here, guys. Tightening range right here. The rest of the market was performing beautifully, so it's just a question of time before NVIDIA broke this to the upside, especially having their GTC conference last week. If there was to be a sell the news event, it was going to be last week during that conference, and the company made it through it beautifully. So now, daily uptrend recaptured by the bulls as we cracked 921, which is what I was saying all week. Now, daily uptrend, your weekly move higher simply continues at this point here, guys. No weekly consolidation in sight. We're going to be looking previous all-time highs, 973, and then very closely, guys, $1,000 for your area of resistance. $1,000 roughly is going to be a milestone for the stock. So far, no discussions about any stock splits, but $1,000 definitely a huge milestone for the company indeed. So we'll be looking for a break of those two respective areas over the course of this week. Bulls poised to really break that, guys. No red flags whatsoever. The red flags come in if we break 851 to the downside. There'll be a loss of your daily uptrend, sets up the bears for daily downtrend, and that would be weekly consolidation here, guys. At that point, I'd be looking anything under 800 for a buy. But the way this stock has been performing on a technical basis and also fundamental basis, may be challenging to get those sub 800 levels because that would represent sell-off here from here of about 15%. And NVIDIA really doesn't sell off that much when it does, right? Here we had a negative day in the past. Here you can see prior to their earnings, they also sold off 10, but 15% or better has been a fairly rare occurrence in NVIDIA stock unless you go really back to the last fall sell-off that the entire market had, right? So unless we have a broad market sell-off, NVIDIA, in my opinion, just going to continue to grind higher. Moving on to Tesla. Tesla down 1.15% here on the day. So Tesla just continuing its struggles, right? We were in the context of a general daily downtrend. The bulls put in a nice move, about an 80% bounce, gives them the space to create a higher low for potential trend change. Now, we have to monitor what happens over the course of the week. Big gap down, and the bulls powered through the rest of the day. Can we get a new daily uptrend to really put a bottom to this process here and then crack 178 to the upside? Crack 178 from here. It's a new daily uptrend similar to exactly what happened right here. We're going to be looking for that again. If we regain the daily uptrend, we should be able to get back above this 180 level. These two horizontal lines, 180 to 170, have been the biggest Tesla support of this recent price range. And we also are coming down to the bottom end of this downtrending channel line, which is also a decent area of confluence for the stock. So that's what I'm going to be monitoring for Tesla this week. Can we reset the daily uptrend? And if we do, can we mount above this 180? Continue the daily uptrend here and potentially start regaining as high as possible against this most recent weekly lower high, which is around 205. Need to see as well an 80% bounce to give ourselves the best chance of changing the weekly. Keep in mind though, guys, Tesla deliveries coming out next Monday, not this Monday, the Monday after on April 1st. That will be a huge catalyst for the stock. And then we have earnings a few weeks later after that on the 17th. So really, in my opinion, guys, there's not going to be much price movement on this stock in terms of crazy gains or crazy losses much before your deliveries are reported in 2 Mondays, and then our earnings coming up there quickly. One thing's for sure, If we dip down here, one in the 150 range is where I'll be playing Tesla a bit more aggressively myself. Not really going to touch it much before we get those delivery numbers. Now moving on to Palantir. So Palantir looking fairly decent here as a whole here, guys. All right, 1.27% to the downside, but what are we trying to do? We're trying to reset this daily uptrend here. Keep a close eye on these lows, 22.90. If we lose the lows, daily downtrend simply continues at this point, and then our weekly consolidation simply continues. We'll be looking to the most recent weekly higher low to act as our last line of defense, 22.37. But even if we lose that here, guys, we're coming up on a crucial area of support. Let me just erase this yellow line, red line, sorry. These $21 all the way down to roughly $19 range, huge previous support, previous areas of 52-week high resistance. So if we do pull back here, I expect the bulls to put up a heck of a fight down there, and that's where I'm going to be going shopping for the stock. So we'll see how it goes. We'll take this one day at a time, whether or not Palantir is able to recapture this daily uptrend and mount a little bit more of a weekly rally into its next resistance point of 28. If it can't do that and we start rolling over here, well, I will be a juicy buyer down here, $21 to $19. Looking fairly good for me. Now it's just kind of stuck here in limbo mode, halfway between its 2 points, trying to re-get that daily uptrend. So we'll see what happens over the course of next week. Now moving on to PayPal. PayPal coming down here 2% to the downside here. Was a red day mostly for the markets on Friday, but PayPal has some decent space, anything above 62.55. Just looking to protect this daily uptrend, right? So need to set a higher low above here. Good thing we have a lot of moving averages down there, right? This 200 daily EMA, which is this green line right here, which we haven't been back above since October of 2021, right? We're finally above it in a more consistent fashion rather than back here when it was the shock the world event. Right now we have a little bit more of consistency above these moving averages right here. We're above our short terms as well. So that should be providing a very juicy area of support. $63, $62, the area to watch for PayPal. Currently, beautiful daily uptrend in the stock, and also in terms of the weekly as well, we're getting some really nice technical breakout levels here on the weekly format as well too. So weekly uptrend in motion for the stock. In my opinion, guys, if we can continue this daily uptrend in a healthy fashion, we do have the technical breakout of the downtrending channel line as well as a whole. In my opinion, your next price target for PayPal, realistically, guys, should be very close to around the $75 mark. That would really complete our weekly expansion phase into that level, and that would be a heck of a nice price here after being trapped down here. This would be pretty much, we haven't hit this price pretty much in the last year at this point, so should be poised to be running fairly well now. Monthly uptrend is almost underway. Would need a break of 68 to really guarantee a monthly uptrend. And look, we haven't been in a monthly uptrend, guys, since 2020 and 2021. We're starting to get there now. So all in all, guys, looking good on PayPal. If it does come down here into 63, 62, I may be tempted to make some short put plays here, $62, $61, trying to just get the most of this breakout as I can. So now we're through all our stocks here, guys. Let's take a quick look into my portfolio, and then we're pretty much done. All right, guys, so taking a look at the portfolio here, you can see that currently, as of Friday's close, we're sitting about 5.16% year-to-date performance, really underperforming the market so far here, guys, right? NASDAQ up about 9.5% on the year, and even the S&P 500 is outperforming us currently, standing at about 9.7%, right? So after a very rocky start to the year here, being assigned some plays in late November and December that were China-sensitive plays and also interest rate-sensitive plays, it was a relatively rocky start, but we were able to kind of roll out of those positions at a profit here midway through February. And since then, it's been fairly stable. However, last week, I was pretty much muted on the sidelines. Really, the last 2 weeks as a whole, guys, been very cautious leading into the meeting with Jerome Powell. But now that we have renewed confidence by the Fed, I really think it's going to be easier and easier to really catch up to these indexes. A lot of the premium that we've been writing have been offset by a few declines in share prices in underlying assets that we control in the portfolio. So let's take a quick look, guys, at what we did over the course of the week. So as you can see here, guys, there's a number of positions that got zeroed out on Friday. Those are just because those expired worthless. So Apple 175s, we got assigned more Apple shares. Apple, I obviously wrote this position after Jerome Powell, and then I could not predict that Apple obviously was going to have a lawsuit. I was really expecting the share price to stay above 175 by the Friday close, especially after such a heavy close on Wednesday, closing up almost near 179. But then you can see here, guys, the very next day, right, they lost roughly $8, $9 in share price value because of that lawsuit, and that's why we weren't able to recover. We got assigned on Apple. We do have 200 shares now. Our average cost across those 200 shares, premium received, and the different strike prices that we were assigned, right? So we got 100 at 180, then 100 at 175, plus the little bit of credits that we got. Our average cost is now down to about 176.86. So I'll be looking for this stock to grind higher and won't be writing covered calls until we really mount above my break even. I really want to get as much juice out of this one possible. So I really want to be writing covered calls when we're back in the 180 range. So that's about it on Apple. These plays pretty much ended worthless. So we had the AMD 167.5s that we wrote earlier on the week. I think I updated you guys after Wednesday's video on these AMDs when I bought them, right? So these are pretty much already captured on Wednesday's video, but if you want to see the fills here, I'll just bring them up real quickly. So the AMD fills, we got about 60 cents for those, and we rode them through Friday, pretty much ending worthless. BABA, $77 calls. Well, BABA is not above $77, so we did not get called away. Our average cost on BABA now at this point, guys, is 76.76. So really getting really close to current share price, right? Writing a lot of premium. Sorry if you guys can't see this, my bad. Let me try to blow it up a little bit. So after writing all of this premium here over the past couple of months, our break even is now down to about 76.76. Very good. I will continue to either write short puts down here at 70 or lower to decrease our cost basis here. And as we approach here our higher levels, that's where I'll be writing covered calls, really a bit in the middle right now. So we'll see what happens for next week. But I'm happy, was able to generate a lot of premium on BABA since being assigned. Our average cost is looking very good now. And I love these long-term valuations of the stock. So looking forward to this one recovering perhaps in the later part of 2024 as China is still in a little bit of an economic drawdown right now. Now moving on to FedEx, this was an earnings play. We took the 237.5s on Thursday pretty much. Right, so we wrote the 237.5s and we got pretty much for those on FedEx. I can show you them right here pretty much. They were FedEx 237.5s for $1.40. So got some juicy premium on those. Was fairly happy. It was below the expected move, so I figured I should take that trade. Looking fairly good. $1.40. We were able to close those. Pretty much they expired worthless. Google 147s as well. We wrote after Jerome Powell. Those ended worthless. The Googles, how much did we get on Googles? I forget off the top of my head. They should be around here somewhere though. We got about 35 cents for them after Powell. It was for the Friday close, so didn't get that much. Expired worthless. Nike as well. The 106s and the 91 puts expired worthless. So I got some decent credits on those. These were worth about $1.77 worth coming in to this week. The Nikes as well. If I take up the chart on Nike, Nike obviously dropped after earnings considerably here, down to about $94. So we weren't assigned at 91 and we weren't called away at 106. The total net credit, you can see here, we got 64 cents for the 91 puts that we wrote coming in at earnings and the 106 calls for $1.77. So our break even on Nike now is down to about 109, but I do still want to write puts aggressively here in the lower $90 range here, guys, because if I get assigned at the lower 90s, which is really the bottom end of this massive a year and a half worth of support area, right? If I get assigned in the lower 90s, which is fair valuation for Nike, in my opinion, well, it's going to bring my cost basis really down to $100. I think $100 is more easily attainable than for the stock at these current prices than perhaps my cost basis at 109. So I'll be looking to lower my cost basis a little bit more so we can really start writing some juicier covered calls on this thing and eventually just get out of the stock as a whole. Even though I do like this levels, we have been in it now for 2-3 months. So really want to start rotating out of that position if I can. Now, we also have a few calls that we have running here, guys. So the Apple calls that I showed you guys the other day on Wednesday's video, on Thursday's video, those are still in action. So Apple 180s, we got, one call here for 431. We'll see what happens with that. We also have the Apple 180 calls for May the 3rd. So 2 different dates, same strike price, fairly confident in those. And then we have the Amazon. So I took this Amazon trade on Friday, guys, because I'm pretty sure we're going to get that breakout. We went with the 160 in the money calls. These are leaps 1 year out. March 21st, 2025. We paid about $37.86 for them, guys. So almost $3,800 for those calls, right? But the upside potential is very good. I'm potentially expecting this stock to go all the way up to about $220, and that would represent upside potential, depending how fast it happens, of anywhere between 70 to 100% on this option. So looking very good. Went in the money. This is a 75 delta. Usually I go with about 75 to 85 deltas. It's just a fancy way of saying it has, the reason why we usually go for 80 deltas in terms of our LEAP calls, guys, is because it represents the best risk to reward, in my opinion, for the cost, right? So it really represents a decent cost for a LEAP option, and the upside is fairly good as well and gives us a decent exposure to leverage. So, we control exposure with 100 shares, and we're only spending, instead of spending, current share price is about 180, right? So instead of spending 18 grand, we're only spending about 4 grand for the same exposure and representing the same upside potential. So looking good on those Amazon calls. We still have the rest of our swing trades as well. Our Canadian banking shares are doing fairly decent. This week, however, was a bit of a mixed and matched week, guys. So take a look at the premium I was able to generate. Here's all the trades we made over the course of the week, which you guys may remember. The pin duos and pretty much all the ones we ran over. The CHEWY ones as well are down here. The MICRON from earlier in the week, the Intel that we closed as well, that I didn't go over here, that were featured in Wednesdays and Thursdays videos. So you can see the total premium collected. It was a very decent week, about $1,248 of premium collected, right? Not bad. But consider, guys, the reason the portfolio is pretty much down from your high here on March the 20th. Well, we had a few things working against our premium. Number one, we literally lost about $600 on Nike, right? From 101, almost $700 rather, over $700, from 101 down all the way to about 94. So $700 of unrealized losses kind of counterbalances a decent amount of our premium. And the other one, the reason that it went down, the reason that the portfolio stayed flat over the course of the week really was Apple, right? So Apple, prior to the big sell-off event, was trading even, before Jerome Powell and whatnot, was really trading around 176, 177, as high as about 178, and then took us all the way down to 172, right? So that's pretty much another loss, unrealized loss here, down about $600 on Apple as well. So take those two big drawdowns in share prices, right? Nike and Apple, and then it pretty much offsets all the premium that we were able to write. So that's why the account remained roughly flat on the week here, guys. But just keep in mind, if Nike and Apple do recover share price here, rapidly in the next couple of weeks, that's really going to bring all of this realized premium to the forefront. So it's really good that we were able to balance some unrealized losses with some realized premium. The account stays flat. So when our share prices go back up, Nike and Apple, the account is really going to kind of go up twofold, right? Couple that with the fact that coming into next week, we really don't have that many assigned positions anymore, right? Nike, Baba, 200 shares of Apple. We have full buying power for the forthcoming future, for the foreseeable future. So going to be looking to put in more, $1,000 weeks coming here in the next couple of weeks as well. So the portfolio, that's why I say the portfolio really should have no problem catching the indexes and eventually surpassing it. I agree with you. It's been a bit rough on the year so far to date. Would have liked to have been outperforming the indexes so far, but that's just the way the cookie crumbles, guys. Been generating some really decent premium over the past couple of weeks, so really have nothing to complain about. Going to try to really juice this portfolio up here coming into the next 9 months of the year. Last year's performance, as you remember, guys, it was about 75% year to date. This year, I am expecting to at least outperform the indexes. Should be generating anywhere between 30 to 50% will be my baseline, and everything above that, guys, is going to be pretty much a bonus. So going to be looking forward to this year's performance. So hopefully that was educational and helpful to all you guys. And if it was, consider dropping a like on the video. Would really appreciate it. Consider subscribing to the channel if you're new. Almost 1,000 of you have subscribed so far. I love each and every one of you for the time that you give to me while watching my videos. Really appreciate it. Hopefully the content has been good. And lastly, guys, if you have any questions at all, please feel free to leave them down below in the comments. And we'll see you in tomorrow's video. Tomorrow, the Sunday night recap, top 5 options plays for the upcoming week. So take care, guys. See you soon. Peace.